This meeting is being recorded.
2022 has been a bloodbath for stocks, bonds, the 60/40 portfolio. I'm curious, will 2023 be any different? Have we learned any lessons? Let's bring on a 10-year Wall Street veteran to have these discussions. Taylor from Life Goal Investments. How you doing, buddy?
Let's do this. I'm excited because you always beat me up on the analyst, like I'm an analyst putting out these projections, which I'm not. We manage portfolios. We make our own analysis, etc. But let's talk about some of these analyst projections because it doesn't look like the market has learned a huge lesson when you look at what the analysts are expecting to come here in 2023. It looks quite the contrary, actually.
Yeah. So the first thing I want to talk about is I think we're finally seeing retail capitulate. I don't know if you saw this stat I talked about on the daily financial news. $45 billion was taken out of the market last week proposedly for tax loss harvesting. Easy for me to say. But I think we're starting to see retail crack. We're seeing Tesla just go one direction, as I think it's the ultimate retail stock when it cracked. Apple has been on a downward trajectory. I did a video 3 or 4 months ago. When these folks crack, it's a sign. And there's talk of Apple going sub 100. I'm actually not sure where it's at today. Chicken Genius talking about Tesla going to 60. So, yeah, did retail learn any lessons of this year, you think?
I think they did. I think they did. I think they do every time we hit a recession. And it's not that these lessons that are learned now are going to perpetuate into the future. They're going to go back to the same old behavior. But what happens is, there's a famous line in investing. It's the old Wayne Gretzky line. You don't skate to where the puck is, you skate to where the puck is going. And what you see time and time and time again is people skate to where the puck was. So what'll happen going forward now, really likely, is people will look for things that did well in 2022. So they'll think there's going to be a recreation of that value trade, that dividend growth trade, that energy trade. Energy had an absolutely phenomenal year when everything else got really
Oxy was the best stock of the year.
Was it? Yeah,
Oxy Petroleum, with the one that Warren Buffett got behind. Yeah.
Yep. So here's just some stats on earnings. So earnings for the year are estimated at this point, which we're right at the end of the year. So we'll get our Q4 earnings here, and that'll be the entirety of the estimate that we're looking at right now. Analysts are estimating that earnings will come in at the end of the year at plus 5.1%. So with that, understand this, that earnings are positive. Now they're not positive to what they have historically been. So the average earning growth for a year is 8.5%. So we're 3.5% less than trend, exactly right. But if you back out earnings from energy companies were positive 152%. So if you back out that, earnings would be negative almost 2% year over year.
I don't think most people see that.
Yep.
That is interesting. Okay.
Yep. And this is why, and I think we're going to talk about this in the next episode, or one of the next episodes, is that the market is not the market. It's not, hey, throw a dart and everything's going to do well. The index goes up in unison, and there's going to be a bifurcation. And I think you're seeing that play out right now. And one of the points you just made a couple seconds ago is the fact that, like, Tesla, massive meltdown, Apple, massive meltdown. Those were both top 5 names in the S&P 500. So you look at it and you go, like, this thing is not equal weighted. The S&P 500 is not all 500 constituents carry the same weight. No. Absolutely not. It's market cap weighted. So it's very disproportionately rated towards the top. So when you start to get a meltdown of Tesla, when you start to get a meltdown of Apple, you start to get a massive meltdown of the index as a whole. And Apple actually has been the bellwether through this really tough 2022 market until just recently. You're starting to get a rollover in Apple as well.
Yeah, when I look back to 2022 as an investor, and we could talk about GameStop and Bed Bath and Beyond, all these stocks. If you've ever seen a 5 or 6 year old soccer game, that's what I think stock investor is. And if you don't know what I'm talking about, basically, it's a pod of people just moving together, right? So I would ask yourself, are you living in an echo chamber where all you're hearing is the same stuff? You're not being intellectually honest and challenging yourself. I think there were a lot of 5-year-old soccer players that if you asked them today, they would not even know why they got into GameStop or, any stock that was crazy.
Yep.
That's a problem. And I don't think we've learned our lesson.
Yeah, I think when you look at it, I think the easiest thing to point out is crypto. And you go to someone, and we've had this discussion before, but I'll reiterate it. my golden rule of investing, if there was one, this might be it. It's if you can't explain why you're buying it, what it is, what the intrinsic value of it is, you can't buy it. So if you're buying crypto and you totally understand the blockchain and you think it's going to revolutionize financial payments, whatever it is, and that's your belief and you're educated in it, perfectly fine. Go ahead and buy it.
Go nuts. Yeah.
But well, I'll say go nuts to an extent, right?
Yeah.
Maybe
a portion. Yeah.
Yeah, maybe you're able to own 5% if you have very, very high conviction in something that's that volatile. But if you can't articulate to me in third grade language how this is going to change the world because that's how it was being priced, you can't buy it. You just simply flat out.
You mean if I told you somebody on the internet told me it was going to go to the moon, that would not be a good answer? Okay.
Yeah, even if that person's Mark Cuban, who is absolutely phenomenally intelligent, he's a great investor over time. Yeah. Even if he's the one saying go ahead and buy it, you need to have that skin in the game yourself to go out and actually do the research to understand what the heck is going on.
How about Dogecoin and pick on Elon Musk again? Oh my
gosh. Get out of here. That thing was built as a joke and people are buying the hell out of it.
Yeah, I couldn't believe it. Well, let's talk about 2023 because I think that's where we need, because again, 2022 is over. We can lick our wounds. We can cry. It was a bloodbath. But I'm interested in 2023. I'm going to put 50K to work. It's one of my New Year's resolutions or goals for the year, whatever you want. And I'm interested where we go in the first half. I think it's going to be an earnings recession. I think these analysts that I love to pick on you about are going to get religion or whatever you want to call it. And
let's talk about some of the numbers around that.
Please.
So if you look at predictions, and this is just posted in Barron's this past weekend, but if you look at predictions for the average analyst for this upcoming year, the S&P 500 will be up 13.4% for 2023. Positive 13.4% for 2023.
Now, just so I'm clear, is that the stock market or earnings up? Which one?
That's the stock market. So the S&P 500 will be positive from this point through 2023, 13.4%. Here's the stat you're going to love. Here's the stat you're going to love. Okay. Take a guess. I'll let you actually throw a dart here and then I'll give you the
I like
number.
that. I like to throw darts.
Over the past 20 years, where do you think the average analyst has, I'll let you know, they've overshot. And that you would have guessed that. So how much above the actual result do you think that the average analyst estimated the S&P 500's return would be for that period of time, that 1 year period of time?
18%.
8%. It's bad. It's bad. 8%. So again, you think about the average return of the stock market over the last 100 years is 10%. The average analyst is estimating a 8% increase above what actually comes in. And when you actually dig down a little bit, it's not the average year. The average year they come in about ballpark. They come in ahead above what they should have, but they come in at about the right spot. Where they miss is a year like 2022. Right. So if you look at what their estimate was at the beginning of this year, the average analyst compared to where we are right now, they're 33%. Their estimate was 33% above where we sit right now. And
they miss bad.
When they miss bad. They missed bad in 2002. They missed bad in 2008. When the market falls apart, they can't see it coming. And so don't ever expect analysts to tell you that we're going to see a bad market because they just don't.
Yeah, they never do. Yeah. If this is, the thing for me, again, as somebody who's looking to put real capital to work and actually has already done it, I bought JP Morgan. I bought JP Morgan 1 tranche of 4, and I bought Blackstone 3 of my 4 tranches. Yep. I just bought another one last week. I think it's going to be the stock pickers market. We're going to talk about that in video number 3. But yeah, when I look at lessons learned, I don't know that Wall Street has learned the lesson because again, they kind of lean positive. The retail investors, I think, are still licking their wounds. I think they're asking themselves, how bad can this be? I think what retail is going to do is they're going to sit in cash again. And as it always is, when you're sitting in, that's the wrong attitude. You need to do your own work, your own research, and find your company. Stop living in echo chambers. Stop playing soccer as a 5-year-old. Do the work, folks. It's out there.
And stop being so darn concentrated. Concentration can blow you up. And that's exactly what happened between crypto, between the tech stocks, between Tesla. Concentration in those names is what blew people up. Now, I'll talk out of both sides of my mouth, though, because on the other end, you say, okay, I want a diversified basket of stocks, bonds, whatever it is. Bonds have not done their job this year. So
No.
bonds have taken it on the absolute chin. This is the worst year bonds have ever experienced since 1976, since that index was created.
This is the worst year for the 60-40 portfolio in 40 years, at least.
Yeah. And the difference is this isn't the worst year for the stock market. Stock market's down what, 19% for the year, somewhere in that ballpark.
It's not the
bonds.
worst.
It's the bonds that are getting absolutely torched. So the worst year we've ever had, going back to 76. Again, the index of the Barclays Ag, which is kind of like the S&P 500 for bonds, was created in 1976. That's why I keep quoting that year. But the worst year we've ever had, is down 2.92%. 2.92%. Right now, the bond market's down about 12% for the year. So we're at a four-time multiple of what bonds have done in their worst year ever. And I actually think right now that bonds are a place that people need to start looking. And I have a lot of conviction in that thought. Because you have a couple things here. One, investing is a game of reversion to the mean over time. And so we've just gotten the pendulum has swung so far, 4 times more than it ever has in that negative direction. And then what also comes along with that is when you look at bonds, it's a total return game. It's a function of you getting a coupon and you also getting potential price appreciation or depreciation. So what you've had this year is you've had now a buffer being built in to bond prices by the coupon increasing dramatically. So take like a 10-year treasury, as the example, like the base case, the most boring thing on the planet. Right now, a 10-year treasury yields about 3.75%. Last year, at the end of last year, it didn't even yield 1%.
Oh.
So all of a sudden you have 300 basis points, 3 whole percent of cushion that you did not have last year. And the best time ever to own bonds historically is coming off peak inflation. Coming off of peak inflation, which I think a lot of people would argue that for the cycle that we're sitting in right now, we're likely coming off peak inflation.
Yeah, I think the 9/1 print will be the high for CPI headline, which is
if it's
August,
not,
I think. If it's not, we're in big trouble.
June. So
June.
9/1 was June because it's perpetually come down since then. But if it's not, we're in trouble, and we're in trouble again in bonds, and we're more in trouble in stocks at that point.
Yeah, totally agree. Taylor, you put out amazing stuff daily on Instagram. What's the page and how can people follow you?
Yeah, thanks so much for saying that. We're at Life Goal Investments, plural, Life Goal Investments on Instagram. And again, we just try to take the commentary from a big, broad standpoint that you're seeing on CNBC and whatever, and make it tangible to anybody.
Yeah, no, you bring it down to a level that's educational, and frankly, many posts are fun. You do a great job of it. So very well done, Taylor.
Thanks so much for the kind words, Michael. Appreciate it.